Dan, it's great to have you back. Is it just a coincidence these are kind of anti-ESG trades?
Well, I think it's a little bit of a coincidence right now because I think, Kelly, what we're really looking at is you're looking at companies that are undervalued, that have very strong earnings momentum, and ones that are going to generate a very high yield while you wait. I mean, if you look at Phillips that you alluded to, is that, Phillips is at a point where the stock is still down about 20%. And yet overall demand for energy is only down about 10% from pre-pandemic levels. And so you have a stock that is clearly undervalued. About 66% of their overall revenue is really coming from upstream, from refining and from storage. I mean, they're at a level right now, they're trading at about a 12 PE, and yet it has a 4.4% yield. So to me, it's a way to play on the energy side. It's certainly one of the most undervalued names that you have in the energy complex, and yet you have a significant amount of upside with a lot of certainty. It's undervalued, and you get almost 5% while you wait. So I think it's just it's a good, sound value, and along with that same yield trade, if you will, as this market potentially stalls out here, is Altria. I mean, it's one of the sin stocks, but it's trading at a 10 PE. It has 10% free cash flow, and it's currently paying us a 7.3% dividend yield. So you're going to get a 7% return with a 30% premium of free cash flow over that, and while you wait this out.
Well, and by the way, Altria has been a great investment for the past 20 years, while, pension funds like CalPERS have divested from it. And you have to wonder if a similar phenomenon plays out now across the energy space. Altria is not just cigarettes either. They've diversified. They have 10 to 15% of their income from beer and wine business stakes. I think they could be a player in the cannabis market and so forth. But let's go back to what you said about this all being kind of a yield play, maybe a cyclical recovery play. Tell me about that. I mean, what do you think when you wake up and see the 10-year yield parked at 1.35%?
Well, look, I think you're in a situation where we have a market that's being largely driven by three things right now. And that, number one, is that there's a tremendous amount of liquidity. We have to realize that the Fed has put $4 trillion of assets in the market in the last 15 months. And even if they do nothing, there's another trillion that's going to come in the next year. So there's a lot of money that's chasing a lot of areas. A lot of that's going to come into the market. And in essence, from consumers and investors, there really isn't a lot of alternatives and places for them to go. And certainly the sentiment is being buoyed up by very, very strong earnings. And we're going to have good earnings again this week. I mean, we're likely to see this quarter be over 50 for the S&P, and we're going to be at over 200 in the S&P run rate. So people are going to continue to gravitate to this market. I think when you're seeing what's happening with overall interest, I mean, look, the Fed is going to continue to issue paper. You're seeing a demand for it, and that liquidity is going to drive this market, though we think the earnings as we go forward for the second half of the year are really going to be the overall driver of this market. It is going to be hard, I think, to move forward with higher PEs. So earnings are really what we're very focused on, and we think we'll start off a good week this week.